Breaking, the 2026 banking collapse has officially begun. Imagine waking up one morning, checking your bank account, and realizing that the safety you've always relied on, your savings, your paycheck, your access to cash might no longer be guaranteed. This isn't a distant maybe scenario. It's unfolding right now. Over $2 trillion in liquidity has vanished from major banks in just the last 3 months. That's more than the annual GDP of some small countries. For everyday people, this isn't just a number, it's your grocery money, your mortgage payment, your rent, all at risk if the system starts to falter. Hi, this is Macro Rewind, and today we're diving into the chain of events that are shaking the global banking system to its core. Before we go any deeper, if you want to understand how these events could affect your personal finances, hit that like button and subscribe so you never miss updates like this. The first thing to understand is the problem itself. Banks are not just where we store money, they are the engines of the entire economy. They take deposits from people like you and me, then lend that money to businesses, homeowners, and governments. That's how jobs are created, houses are built, and small businesses survive. But here's the issue. Banks have been borrowing short-term and lending long-term. In simpler terms, they promise you can withdraw your money anytime, but they've invested it in things that can't be easily sold without losing value. Think of it like lending your neighbor money to buy a house, while promising you can get your cash back anytime. What happens if everyone comes asking for their money at once? That's exactly what we're seeing today. Rising interest rates, unexpected defaults, and a fragile financial system are triggering withdrawals at a pace banks cannot sustain. On paper, these institutions look fine. But the reality behind closed doors is different. Liquidity is drying up, and some of the world's largest banks are scrambling to cover short-term obligations. This is not speculation. The signals are clear. Historical patterns from the 2008 crisis show that small cracks in liquidity can quickly escalate if confidence falters. But why now? Over the last decade, central banks have kept interest rates unusually low that encouraged borrowing, inflated asset prices, and pushed banks into riskier investments. And now, the pendulum has swung. Rates are higher, and many loans, particularly commercial real estate and tech sector debt, are under stress. Banks that thought they were safe now face losses they didn't anticipate, and when losses mount, confidence wanes. If depositors sense trouble, they start withdrawing funds, creating a domino effect that spreads through the entire system. Here's a hidden angle most people don't see. Smart money, the wealthiest investors and institutional funds, have already started repositioning themselves. They understand where risk is highest. That means the average person is exposed to vulnerabilities before the market fully reacts. While hedge funds and central banks can adjust quickly, your savings don't move on their own. If the collapse spreads, even a seemingly minor bank issue can have real-life impacts: delayed paychecks, restricted withdrawals, and sudden credit crunches. Let's break this down in a simple way. Imagine your bank as a grocery store. Normally it stocks just enough to meet daily demand. Now imagine demand spikes because everyone rushes in at once. The shelves empty fast. Replenishing them takes time and suppliers aren't prepared. Customers panic, prices might rise, or the store may even limit purchases. That's essentially what happens when a bank faces a sudden liquidity crunch. The system depends on trust, and once that trust falters, the impact is immediate. But it's not just theory. In the last few months, multiple regional banks have collapsed or been acquired under emergency measures. Markets have reacted with volatility unseen since the early 2000s. Yet, mainstream media often frames this as isolated incidents, while the underlying systemic risks remain. The bigger picture is that interconnected banks, insurance companies, and investment firms create a network where one failure triggers another. It's a chain reaction. If Bank A struggles, gives Bank B loses confidence, gives lending slows, gives businesses struggle, gives salaries, mortgages, and consumer spending are affected. Historically, we've seen this pattern before. In 2008, Lehman Brothers' collapse didn't just hurt Wall Street, it reverberated into Main Street. Jobs were lost, homes foreclosed, and retirement accounts plummeted. Fast forward to 2026, the stakes are arguably higher because global debt levels are far larger and banks are more leveraged. Yet there's one difference. Lessons have been learned, and some institutions are better prepared. But better prepared doesn't mean immune. Even small disruptions can ripple through the system, especially in a highly connected global economy. Central banks and regulators are stepping in, but their tools have limits. Printing money, cutting rates, and emergency lending can provide short-term relief. But these measures can't instantly restore confidence or undo underlying structural weaknesses. That's why observing where smart money moves gives insight into potential outcomes. For instance, recent spikes in treasury yields, gold purchases, and foreign currency movements suggest that some investors are hedging against the dollar and traditional banking risks.
Ow.
Consider the personal impact. If banks tighten lending, you may see higher interest rates on mortgages and car loans, or difficulty getting approved for credit cards and personal loans. If liquidity tightens further, even daily transactions could be affected, slower transfers, temporary account limits, or fewer ATM withdrawals. Inflation can also surge if money becomes scarcer relative to demand. Your grocery bills, utility payments, and rent could all feel the pressure without any change in your lifestyle. But the most overlooked risk is psychological. Even if your money is technically safe, the fear of potential collapse changes behavior. People spend less, businesses slow hiring, and investment slows. This can amplify the very crisis everyone fears, creating a feedback loop. Confidence is as critical to the system as capital itself. Here's something to keep in mind. The risk doesn't unfold overnight. It starts subtly. Bank after bank may show stress signs, minor layoffs, reduced lending, or asset sales. Most people won't notice immediately. But if early warning signs are ignored, a tipping point can emerge suddenly. That's why understanding the sequence, cause, and effects crucial. Rising defaults gives tighter credit, gives lower consumer spending, gives weaker corporate earnings, gives further financial stress. Every step compounds the previous one. Another historical context. During the Great Depression, bank runs were rampant because deposit insurance didn't exist. Today there are safeguards, but they have limits. FDIC coverage is only up to $250,000 per account, meaning those with larger balances or multiple accounts could face exposure. This is why diversification, awareness, and early preparation matter more than panic. So what should viewers do now? First, awareness. Understanding what's happening and how banks function helps you make informed decisions. Second, liquidity management. Know where your money is and how quickly you can access it. Third, personal budgeting. Prepare for scenarios where costs may rise or access may be temporarily restricted. These aren't fear tactics, they're practical measures. Curiosity loop, but the real risk isn't in the banks themselves, it's in how quickly confidence can erode across other sectors. If the ripple reaches corporate credit, housing, and consumer spending simultaneously, the effects could be larger than most imagined. Keep watching closely because this is where policy, markets, and personal finances intersect. Looking at institutions, central banks are balancing inflation control with banking stability. Interest rate cuts may stabilize banks, but risk fueling inflation. On the other hand, strict controls could prevent asset bubbles, but strain already vulnerable institutions. The interplay is delicate, and small missteps can amplify instability. Another overlooked angle, international exposure. U.S. banks are linked with global finance, meaning turmoil here can influence markets in Europe, Asia, and emerging economies. Currency fluctuations, foreign investment shifts, and trade disruptions are all potential downstream effects. So what does this mean for your everyday life? Beyond bank accounts, it affects your mortgage rates, credit card interest, rental costs, and even the prices of groceries and gas. If the banking system slows, wages may stagnate, loans may tighten, and spending power may decline. Being aware allows you to adjust budget wisely, consider alternative savings vehicles, and maintain flexibility in spending. Remember, this isn't just doom and gloom. There's opportunity in understanding the system. Markets are cyclical. Those who understand risk, stay informed, and act wisely can protect their wealth and even capitalize on shifts. Macro Rewind will continue breaking down these trends so you can navigate them intelligently. As we approach the end of this analysis, think about the broader lesson. Systems, whether banking or personal, are interconnected. A seemingly isolated failure can cascade into multiple layers of impact. Awareness, preparation, and informed decision-making are your best tools. If this video helped clarify what's happening and why it matters, Comment below with your thoughts and share it with someone who needs to understand these risks. And stay tuned. Our next video will explore how alternative assets like cryptocurrencies and gold are reacting in real time to this banking crisis. You won't want to miss it.